Welcome to today's explainer. Look, if you're here, it means you're finally ready to decode the wild world of options trading. I am absolutely thrilled to guide you through this. We're going to strip away all the confusing jargon, focus purely on the mechanics, and build a rock-solid foundation for your trading toolkit.
Ever stared at an option chain and just felt completely lost? Like you're suddenly trying to read the code in the matrix? Trust me, you aren't alone. It is incredibly intimidating to see endless rows of flashing numbers, strikes, and premiums for the very first time. But I promise you, by the end of our time together today, we're going to demystify this completely. You'll know exactly what you're looking at, and more importantly, why it matters.
All right, so let's dive right in. Here's our roadmap for today. We're breaking this down into 4 essential building blocks: the core contract elements, decoding the geography of options, which is your ITM, ATM, and OTM. Then we'll pit option buyers against sellers, and finally, look at how to read the crowd using open interest in option chains. And of course, we'll wrap it all up with your essential takeaways.
Section 1. The core contract elements. Because before we can even think about trading, we absolutely have to understand the physical ground rules of the contract we're entering into.
The first pillar here is the strike price. This is simply the fixed price in your contract that grants you the right to buy or sell. Let's take our Nifty example. If the current spot market price of Nifty is hovering right around 24,000, the exchange doesn't just hand you one single option to trade. No, you get a whole menu of strikes: 23,500, 24,000, 24,500, and so on. And remember, every single one of these unique strike prices carries its own completely distinct price tag, which we call the premium.
Now that brings us to the expiration date. Look, options are a lot like milk. They have a very strict expiration date. This is the exact date the contract ends. If you haven't sold it or exercised it by the evening of this date, the option just automatically settles. In the Indian markets, for example, indices like Nifty and Bank Nifty have weekly expirations, meaning they close out every single week. Individual stock options, on the other hand, typically run on a monthly cycle. So just remember, the clock is always ticking.
Okay, let's talk about the money. When you buy an option, the price you pay is called the premium. But here's where a lot of beginners get totally tripped up. The premium you see flashing on your screen is just a per-unit price. To figure out the actual cash leaving your trading account, you've got to multiply that premium by the lot size. A lot size is essentially just a fixed bundle of shares you're forced to buy all at once. You can't just buy one single share in options trading. You have to buy the whole bundle.
And this brings me to a supercritical warning straight from our source material. Lot sizes are not universal. The lot size for Nifty is completely different from Bank Nifty, which is totally different from a stock like Reliance. Furthermore, the National Stock Exchange frequently alters these lot sizes based on market conditions. So bottom line, always check the current lot size on the official NSE website before you calculate your risk and jump into a trade.
Moving on to Section 2. Decoding ITM, ATM, OTM, the geography of options. Let's map out exactly where our option lives compared to the current market.
All right, we're going to look at call options first. Just think of a call as your right to buy. Let's assume the current market price, the spot price, is exactly 24,000. If you hold a 23,800 call, you hold the right to buy at 23,800 when the market is already trading way up at 24,000. That is a fantastic deal. You've got instant profit built right in, which makes it in the money, or ITM. Now, at the money, or ATM, is simply when your strike matches the current spot price perfectly, so the 24,000 call. And out of the money, or OTM, is when your strike is worse than the current market. A 24,200 call gives you the right to buy at 24,200. But why on earth would you do that when the market is cheaper at 24,000? Right now, it's pretty much useless, hence out of the money.
Now, if that feels like a bit too much to process on the fly, our source gives us a brilliantly easy trick to memorize this. For call options, the lower strikes are always in the money. Why? Well, because a call gives you the right to buy cheap. For put options, the higher strikes are always in the money. Why? Because a put gives you the right to sell high. Just keep that simple rule in your back pocket, and you won't get lost on the option chain.
So let's flip over to the put option and see how this plays out. Notice how it's the exact mirror image of the call. If the market is at 24,000, a put gives you the right to sell. So holding a 24,200 put means you actually have the right to sell higher than the current market price. That is a massive advantage, making it in the money. Conversely, a 23,800 put means you'd be forced to sell for less than the current market, making it out of the money. It just flips the logic entirely. And this exact dynamic explains perfectly why options are priced the way they are. In-the-money options cost significantly more. They command a high premium because they contain a real intrinsic value, meaning they're already worth something if you exercise them right this second. Out-of-the-money options, however, they have a very low premium. Why? Because they hold zero intrinsic value. You are literally only paying for the time left until expiry, essentially crossing your fingers that the market swings in your favor before the clock runs out.
All right, Section 3, option buyer versus seller, the two players. Let's look at the actual combatants stepping onto the field. The asymmetrical risk between these two roles is honestly staggering. The option buyer pays a small premium for a right. Their absolute maximum loss is just the premium they paid, but their maximum profit? Theoretically unlimited if the market just explodes. Now look at the seller, also called the writer. They receive that small premium up front, but they take on an obligation. For this, their max profit is strictly capped at whatever premium they collected, but their max loss is literally unlimited. Because of this massive risk, exchanges make sellers hold a large margin in their account. But here's the real kicker: time decay. Time is the buyer's absolute worst enemy. As the days tick by, their option bleeds value. But for the seller, time decay is their best friend. They are literally getting paid to wait.
I actually want to pause right here and really emphasize a major warning straight from our source material. Option selling carries unlimited risk. Period. It is strongly not recommended for beginners. I mean, just one bad trade, say a sudden unpredictable market crash or a crazy spike, without the proper knowledge or hedging, and you could entirely wipe out your trading capital. Yes, the seller wins more often, but when they lose big. Be incredibly careful.
Section 4, open interest and chains. Because trading isn't just about understanding our own positions, it's about reading the crowd.
So, open interest, or OI, is simply the total number of outstanding unclosed contracts currently sitting active in the market. Every single time a new buyer and a new seller create a contract, open interest goes up by 1. When they close out their positions, it goes down. Think of it as the live bets that are still sitting on the table.
Why does this matter to you? Well, because open interest is essentially your psychological map of the market. When you see massively high open interest sitting at a specific strike price, that level often acts like a brick wall, a really strong support or resistance level. Traders use the ebb and flow in OI to gauge shifting market sentiment. Is panic setting in? Is confidence building? Tracking OI helps you spot exactly where the big players, the smart money, are placing their heaviest bets.
And when you bring all of these concepts together, you get the standard option chain. Honestly, whether you use Zerota, Upstocks, or any other broker out there, the layout is pretty much universal. Your strike prices run right down the middle. Your call options, along with their premiums and open interest, sit on the left. Your put options sit on the right. And right there in the dead center of the action is your at-the-money strike. Suddenly, looking at the matrix doesn't feel so confusing anymore, does it?
Which brings us to Section 5, Essential Trading Takeaways. Let's lock in everything we've covered today.
Here's your quick mental checklist. First, strike, premium, expiry, and lot size. These form the mechanical foundation of every single trade. And seriously, always check those lot sizes. Second, moneyness. ITM, ATM, and OTM work in perfectly opposite directions depending on whether you're looking at calls or puts. Third, know your role. Buyers risk a little to make a lot but are constantly fighting time. Sellers risk a ton to make a little, but time is on their side. And lastly, open interest is absolutely your best tool for seeing where the rest of the market is putting their money. Which leaves us with the ultimate question for when you fire up your trading screens tomorrow. With limited risk protecting the buyers and the undeniable advantage of time decay heavily favoring the sellers, which side of the trade are you going to master? Take this knowledge, respect the risks out there, and keep exploring the market safely. Thanks for learning with me today, and keep making sense of those charts.